Hello and welcome to our comprehensive guide on mortgage refinancing. Today, we are diving deep into a critical comparison that many homeowners face when considering lowering their monthly payments or changing their loan terms. We are pitting the FHA Streamline refinance against the conventional refinance, and we will meticulously analyze when each option truly wins. This is not just about interest rates. It is about understanding the total cost of ownership, the math behind the rate savings, the impact of mortgage insurance, and the true out-of-pocket expenses known as closing costs. Prepare yourself for a detailed look at the numbers and the strategy behind each choice. Let us start by defining our contenders. The FHA Streamline refinance is a specific program designed for homeowners who currently have an FHA-insured mortgage. Its primary benefit is the streamlined process, hence the name. This means there is often no requirement for a new appraisal, minimal credit underwriting, and sometimes no income verification. It is a quick and relatively simple way to lower your interest rate, which is why it is so popular with current FHA borrowers. However, the FHA Streamline is not without its costs, most notably the requirement for FHA mortgage insurance premiums, or MIP, both an upfront premium and an annual premium. On the other side, we have the conventional refinance. This is a standard mortgage refinancing option backed by private lenders, typically following guidelines set by Fannie Mae and Freddie Mac. A conventional refi requires a new appraisal, thorough income and asset verification, and a strong credit history. The huge advantage here is that if your loan-to-value or LTV ratio is below 8%, you are not required to pay any private mortgage insurance or PMI. This absence of a monthly insurance cost is often the game changer that makes the conventional refinance so appealing, especially for homeowners who have built up significant equity. Now let us tackle the elephant in the room: mortgage insurance. For the FHA Streamline, you will encounter the upfront mortgage insurance premium, or UFMIP. This is currently 1.5% of the new loan amount, although it can be partially credited back if you are refinancing a relatively new FHA loan. Then, there is the annual mortgage insurance premium, which is paid monthly and depends on your loan term and LTV. This annual MIP is usually 0.55% of the loan balance annually, and here is the key difference. For most FHA Streamline refinances, the annual MIP is required for the entire life of the loan, unless you put down a substantial down payment on the original loan. This long-term cost is a major factor to consider when calculating your true savings. The conventional refinance, as mentioned, avoids PMI entirely if your LTV is at or below 8%. If your LTV is higher than 8%, you will have to pay PMI, but the good news is that this PMI automatically terminates once your equity reaches 22%, or you can request it cancellation once your LTV drops to 8%. This automatic removal is a significant long-term financial benefit over the FHA Streamline. Next, let us talk about closing costs. These are the fees charged by the lender and third parties to process and close the loan. Both refinance options have closing costs, which can include origination fees, title insurance, appraisal fees, and attorney fees. The FHA Streamline typically has lower overall closing costs because it often waives the appraisal fee. However, the UFMIP on the FHA Streamline is also considered a closing cost and can be quite large. Conventional refinances always require an appraisal, adding a few $100s to the closing costs, but the overall cost structure might be more straightforward. When comparing the two, you must look at the total out-of-pocket expense or the amount you are adding to your loan balance. Many borrowers choose to roll their closing costs, including the UFMIP, into the new loan. This means your new loan balance will be higher, but you did not pay anything upfront. Let us move to the heart of the matter, the rate math. A common scenario is this. The FHA Streamline might offer you an interest rate that is 0.25% higher than the conventional refinance rate. For example, the FHA Streamline rate might be 3.5%, while the conventional rate is 3.25%. On the surface, the conventional rate seems better, but you must factor in the monthly mortgage insurance cost of the FHA loan. To truly compare the two options, you need to calculate the effective interest rate. This is your stated interest rate plus the cost of your annual mortgage insurance divided by your loan amount. Once you compare the effective interest rates, the picture becomes much clearer. Often, for a borrower with high equity, the conventional refinance, even with a slightly higher upfront rate, offers a much lower effective rate due to the absence of mortgage insurance. So, when does each option win? The FHA Streamline refinance wins when the primary goal is a fast, low-hassle process. It is the best choice if you have had a recent drop in your credit score, as the requirements are very forgiving. It also wins if your home has lost value since you purchased it, and you are underwater or near underwater. Since no new appraisal is generally required, the lost equity is not an obstacle. It is an ideal tool for a borrower who just wants a quick rate reduction and is willing to accept the long-term cost of MIP. The conventional refinance wins when the borrower has significant equity in their home, ideally over 20%, a strong credit score, and verifiable income. The conventional refi is the undisputed champion when it comes to eliminating that monthly mortgage insurance payment. The savings from avoiding PMI or MIP, especially over a 30-year term, can amount to tens of thousands of dollars. The higher upfront closing costs for the appraisal and verification are quickly amortized by the substantial monthly savings. In conclusion, the decision between an FHA Streamline refinance and a conventional refinance is not a simple one. It requires a detailed, personalized calculation that considers your current loan terms, your home equity, your credit profile, and your financial goals. Do you prioritize immediate savings and simplicity, or are you focused on the lowest possible total cost of the loan over its lifetime? Use the math we have discussed, specifically the effective interest rate calculation and the long-term impact of mortgage insurance, to make an informed choice. Consult with a trusted mortgage professional who can run these detailed comparisons for your unique situation.